Welcome to Investing with Beauchamp and Bright, the weekly financial podcast from IG. I'm Chris Beauchamp, the UK Chief Market Analyst for IG, and this week is our second week of having a guest on the podcast. Aaron is still on his travels somewhere in South America, we hope, and should be back with us next week, we hope, for the final podcast of the year. But this week, I'm delighted to say we are joined by one of our grads, Queen Lampo, who is joining us to talk about how she started investing, and she's come prepared with some questions as well for me, which is great. So thank you very much for joining us.
Thank you for having me.
And how's your week been so far?
My week has been good. I went for the Christmas party last Friday.
Oh, yeah.
So it's been sort of a long weekend, and it's Monday again, and I'm looking forward to the week.
Excellent, good. And when did you join IG? Because you're still relatively new,
yes,
aren't you?
I joined in September 2023, so just last year.
Just a year ago, gosh, exciting.
Yeah.
And currently, you're on the grad scheme.
Yes.
And which rotation are you in now?
So I'm currently doing my last rotation with the financial crime compliance team.
Okay, and what kind of thing does that involve?
So my area of the financial crime team involves like investigating market abuse.
Right.
Specifically insider dealing. So I just look at all the alerts generated and I just investigate on clients' accounts.
I see. So you just keep an eye.
Yeah.
You keep an eye on what everyone's doing.
Yeah.
Essentially. Oh, really interesting. And before that, you were?
Before that, I had just finished my rotation with the risk analytics team.
Okay.
And then I did ESG before that, and then trading services before that.
Okay, so you were chatting to clients and trading services.
Yes.
And how was that?
It was very interesting. It was a very steep learning curve.
And did it still make you take a bet test these days?
Yes, we had to do. It was called the advanced product test. So
yes,
the
they
APT
don't call it
test.
the best anymore.
Yeah. So we had to do that to pass probation.
And that's when they ring you up and they give you a really difficult trade to place, isn't
Yep.
it? Yeah. And that was okay?
It was a bit hard, but now that I look back, it wasn't as hard as I thought it was going to be.
Okay. I'm sure you're much more prepared than I would be. I never did it because I didn't come into the grad scheme, so I've always heard. I mean, when I joined in the dim and distant past, you used to have to be able to shout this across the floor. And then so everyone would know you were doing your bet test.
I see.
And it would be much more exciting.
Well, things have changed now.
Yes, probably for the better, I think, as well. But it certainly is a bit of a rite of passage at IG. Gosh, and risk analytics. Tell us more about that.
So my role in risk analytics was mainly about risk assurance. So I helped with a bit of credit risk management where I look at margins and see if the margins are appropriate for certain clients, if we need to increase margins based on market conditions, and stuff like that, stuff that had to do with risk assurance. So it was quite interesting.
So is that sort of when you've got stocks that are having big moves, is that involved? So I think I was talking to somebody in risk a couple of weeks ago about this, and they want to keep an eye on the ones that are coming up sort of with results and what's hitting in the news wires, that kind of thing.
Yes.
That's how it relates to us, isn't it?
Yes.
So you want to sort of, when you have bigger moves in stocks, you tend to increase the margins, I think, to reflect the underlying volatility.
To show how risky it is.
Yeah, exactly, which is really important, I think, because people misjudge how quickly things can move, I think, and some of those really small stocks, they have crazy movements. I mean, we've had Direct Line, the insurer, move 40% last week in a day because of Aviva's takeover. So you do get these moves in some of the more established ones, but particularly in the small cap names.
Yeah.
They go up on no news whatsoever, don't they?
They do.
Which is always fun, really, especially when we get rung up by news agencies. Why is so-and-so moving? There's no reason.
Yeah.
It's really interesting. And you've come straight from university?
Yes, I had just completed my master's a week before I started.
Oh, wow.
Yeah.
What was that in?
In finance.
Okay.
So I was a master's in finance.
Gosh, you're horrendously well prepared for this.
No, I wasn't.
Was your undergraduate degree in finance?
No, it was in business administration.
Okay.
Yeah.
Very exciting.
So a very different world from business and finance. I mean, not too different, but it was a lot of learning in the past few years.
But now you get to put it into practice.
Yes.
Okay. What made you look at IG?
I think for me, the selling points for IG was the grad program and then the fact that we got to do different rotations. Because obviously most of us that are young don't exactly know what we want to do full time. No. So then the IG grad program was very appealing because it gives you a chance to, move around different teams and see what they do and if you like what they do and if you see yourself being there at least full time or in the foreseeable future.
Yeah, because I think it's important when you're starting out to learn what you don't want to do
Exactly.
as much as what you do want to do. Because when you go through school, there's a sense of what do you want to be when you grow up, all this kind of thing. And some people who I always envied always knew, and I didn't know.
Yeah.
I sort of stumbled into this because I can just write and I've got an opinion, as those of you unfortunate to work with me know. But I think some people just go through life and they know what they do from the get-go. Like be a doctor or a lawyer, that kind of thing. Okay, so that's interesting. So there is obviously a reason why we got you on the podcast, apart from just talking about the grad scheme, which is always interesting. It was because you are one of the people who's really started out investing.
Yes.
Essentially, which isn't massively common amongst people your age, unfortunately, because for a variety of reasons, clearly you're starting out, there's not much money, you've got other things to worry about. But what made you get into investing to start with? What made you think, actually, I need to start thinking about this now to prepare for the future?
So I think when I was in uni, I saw this quote that said the best time to start investing was yesterday.
Yeah.
And I've always been somebody that has very big dreams. Like, I want to own a house one day. I want to travel the world. And it's like, how do I get there? Like, I always thought that I had to find like a very good job that pays very well, and then that's going to help me achieve my goals. But then from a little research I did, I saw that you have to actually start now if you want to realize those goals in the future.
Yeah.
And then the one way to do it is to invest your money. So I just thought, oh, how do I start investing? Do I need like a big sum of money to start investing, to buy a house? Like, how does it work?
Yeah.
And then I found like different providers, and you can actually put like very small amounts to start out. And that was basically it for me, like my starting of investing.
Okay, because I had Rich McDonald on last week, and we were talking about how we both had parents who were interested in the stock market. Was that the case with you?
No, I don't even think my parents even know what the stock markets are.
So it's entirely something you just came across at school or later than that?
I'll say that it was before school. So during my undergraduate in my business degree, I had like a course in investments where we had to build like a mini portfolio for someone based on their risk profile. And I found that very interesting because you had to make them fill a questionnaire, and then they give you like a hypothetical $100,000, and then you have to like allocate it into a portfolio.
Right.
So I found that very interesting. I was like, I want to do this for myself as well. So how do I go about doing that? So, like, do I have to wait till I'm 30, or can I start now? So that was basically my starting points from knowing investments.
Oh, wow. And so you started out with an investment. Have you got a SIP account, a normal stockbroking account, or ISA?
I currently have a stocks and shares ISA, which is passively managed. But then I started out, putting money in stocks I had heard about. I didn't know how to start.
Right, okay.
So I just opened like a share dealing sort of account, and I was just looking at all the stocks that were being on offer. And I could also do like fractional shares. So I was trying to put like very small amounts of money to see like what was going to happen. But then nobody told me that you could also lose money.
Yes.
In as much as you can also gain.
Yes.
So I saw my portfolio value going down, and I was like, I don't want to do this anymore. Like, no one told me I was going to lose, but it was a very interesting learning journey.
Yeah, I think you have to sort of you have to understand that when you go into it, that as the boilerplate says, the value investment can go up as well as down, and people tend to miss the bit that says down. They just focus on going up. Okay, so because a lot of people in the country don't pick their own shares. There's plenty of people who have a pension, but they'll get someone else to manage it for them, and there are those that actually do pick their own shares. So you're actually in a very small
category.
Yeah, very small category. But it's great, really, because I think it's really important to understand what shares are and how you understand a company. Which ones? Any examples of ones you picked?
To be fair, when I started out, I was just doing stocks I had heard everybody talk about. So, the stereotypical ones like Apple, Tesla, those very big share names. But now that I know better, I realize that I actually don't know what stocks to trade. So I have like a managed portfolio that basically tracks like an index fund.
Is that one of the IG ones?
It's similar to the IG ones.
Okay.
Yeah.
Right.
So it's just a managed portfolio, which is like the IG Smart portfolio.
Oh, right. So it's one of the ones that sort of allocate it to various... You've got a sort of pot for US, there's pot for European markets.
Yeah.
And bonds as well. Did you do that?
Yes. So my portfolio is a balanced portfolio. So it's just allocated across stocks and bonds and some ESG real estate, I guess.
Oh, okay.
Yeah.
Oh, right. And do you do it a little bit every month?
Yes. So I put in an amount of money every single month.
So you're doing all the right things. Really.
I'm trying my best.
Well, I know, but it's really hard when you're starting out. And of course, you don't tend to see massive gains or losses really in the short term with these things. So it's almost, you get into it and you fire up the account and you put some money in the various investments, and then you just sort of have to wait.
Sit and wait.
Yeah, really, which is, I think, the lesson a lot of people struggle with is a lot of the time, for most people in markets, doing less is the key thing. Because there's always that urge, both in investing and trading, to be doing something all the time. You're putting on a position, to be closing it, to be looking at new investments. Whereas a lot of the famous trader Jesse Livermore, you've probably not heard of him, but if he was an American about 100 years ago, and he made and lost essentially billions several times. But he said, it wasn't my thinking that made me my money, it was my sitting tight. It was his sitting there doing nothing and allowing these investments to work in his favour. So I think it's quite hard, isn't it, really?
It is, because, like, just sitting down and watching it go up and then going down. And obviously, for a beginner like me, I don't know if the going down is a bad sign. Like, do I just take my money out now before it goes further down? Or do I just wait? Like, it's very, very, very hard to just sit and wait. But like you said, the time and just sitting and waiting is, like, the most key part when you're doing an investment. Yeah.
It's really hard, isn't it? You don't understand how... Well, you clearly don't know what's coming next, do you? So you have to sort of put your money in, and you have to hope that...
Things go well.
Yeah, that things go well, which is really interesting. Any particular stories so far? Any horrors? Any good, good performers?
I'll say there's been good stories and there's been bad ones. So like I said, when I first started out, I was just looking at the most popular stocks, or whichever ones I could see like a green arrow on that says that the stock is going up. And basically...
that's what you want, isn't it? I think that people underestimate the importance of picking something that is going up, because it's the market is telling you something.
Yeah, but then I didn't understand that, like, the percentage sign at the corner means that it's already gone up. I thought it meant, like, it's going to go up. So I just, like, put a lot of money into those type of stocks, and I saw my money just going down and going down, and I panicked and took everything out. And there was just, like, too little money left by the time everything was...
But I think it's important to start out, as you're doing. You start out small, and the pot grows over time, doesn't it? Warren Buffett, you must have heard of Warren Buffett, the famous investor.
Yes.
So he says it's like a snowball. You have to just start rolling it, and it gets bigger and bigger over time, and then eventually it gets into this really big pile. I think that's the key thing, really. But you're looking for a longer term horizon thing, really, aren't you?
Yeah.
I think. So your key lesson is to learn that there are ups and downs in markets.
And just to
really
wait.
Important. Yes, and just doing less is usually the key thing, I think, particularly. Now, you have come with a few questions as well, which is great, because I think this should be a two-way thing, really. So, fire away.
Okay. My first question to you would be, how do you suggest that a beginner balances the risk and reward when building their investments portfolio?
Well, I think there are several factors you need to think of when you're starting out, and obviously you don't have a huge amount to play with. The key thing is that concept of diversification. So it's not to put all your eggs in one basket, and there's plenty of cliches in investing, but it's that idea of you won't be able to capture all the gains. For example, it's really easy to look at things like Nvidia this year and think, oh, if I bought Nvidia a year ago, if I put all my money in Nvidia, I'd be rich. Exactly. But there's the downside of that, which if you put all your money in something else that hasn't done very well,
you'll be very poor.
Yeah, you'd be very poor. So because you don't know what is going to happen next, and nobody knows what's going to happen next, which is always thing to remember when you're watching these people, including me, on TV saying this will happen and this will happen. Nobody's got a crystal ball. So that's why you have to put a little bit into various pots, and over time that should grow, and you should see some will do well for a while and others will not so well, and then the performance shifts. It's great if you look at sort of what they call these heat maps of the sectors of a market that perform well this year and then next year and it's completely different every year. But over time you're investing in either a portfolio of stocks or a group of assets, and that kind of spreading your risk around reduces the possibility that one will do really, really badly and thus give you a really big hit to overall performance. And the other thing you should do, which is what you are doing already, is this what they call dollar cost averaging or pound cost averaging, which, if people are not familiar with that, it's where you put a small amount every month. You say, oh, I've got X amount, but I won't put it all in straight away. And it does really well when the market's going up every month, as it has done for the last couple of years. It does mean that you have to then keep doing it in a falling market, So in one sense, you're doing what's called averaging down, but the idea is that you don't then go in at one single entry point, and if it will just over the course of time average out again. So you're not trying to time this market in any particular way. You just accept that yes, there'll be times when it does go up, and there'll be times when it doesn't. It goes down, but you're trying to smooth that out as much as possible, and that's why we always say pound cost averaging is a really sensible method to approach investing.
That's very interesting. Just following on what you said about diversification, how important do you think diversification is in a beginner's portfolio? Because I've heard so many times that when you're young, you have like an age horizon, so it makes more sense to invest in stocks. So when it comes to a beginner's portfolio, is it diversification in the terms of different asset classes, or diversification in maybe one asset class like stocks, but in just different stocks?
Well, it is both, really. I think it partially, as you found out with the managed portfolio, is that it boils down to every person's appreciation of risk. And some people like risk, and some people would rather stay away from it as much as possible. The kind of people that prefer a cash ISA, that kind of thing. So you have to think of that before you start. But if you're looking at the longer term time horizon, and for you, of course, you're looking at decades, you can be a bit more aggressive, shall we say, and use that term loosely, but be prepared to take that risk, because obviously with the risk of big gains comes the risk of losses. That's why growth companies like Nvidia have done so well, because when they grow, they really grow. They enter periods of stagnation. But you can really do it. You can sort of say, I think maybe 60-70% of my portfolio could be in more growth stocks, or stocks likely to do well. And then you could put some of it aside in boring stocks, like utilities and I'm trying to think of other particular boring stocks, but that kind of thing where they've got the dividend and they're not going to grow massively. They're not going to grow to the sky because they're big companies, but they do pay you a solid amount every month in dividends. Because that's the key thing as well, that we're not just looking at capital growth. You're not just saying, I'd like the share price to go from $1 to $100. You're also saying, I'd like to get paid for my holding as well with the dividend. So that's really important. If you look at returns, it's always the dividends that make the difference. So ideally, if you can find a stock with good earnings prospects, but also pays you a dividend, you're kind of getting both. Now, there's a lot of debate around what you should do, because some people would say actually just go for the earnings growth. But for most people, you don't really want to go all out on the aggressive companies. I think it makes sense to have to try and moderate that slightly. And okay, you won't get the huge returns of investing all your money in one stock, but nor will you see a lot of those moments when it just drops 50%. Because stocks can do that. They can double in a year, but they can also drop very, very quickly.
Very volatile.
Exactly. And that's not much fun when you're starting.
Yeah. Okay. So piggybacking off what you just said, in particularly volatile markets like markets have been recently, what type of investing styles would you like advise for someone starting out to look into? Would it be more of like an active investing strategy where you're like, okay, like Nvidia is doing really well this year, so maybe I should look at stocks like Nvidia or stocks in the tech industry? Or would it be more of like, I'm starting out now, let me just look for like a more managed portfolio, like which is very passive, which would just sit there and I just put money inside monthly and just watch it grow?
Yeah, I think you can approach it the same way regardless. You can look at, say, putting some, maybe half of it, for example, in the managed portfolio, and then you've got that diversification anyway. And then it has to be a learning experience as well, I think. So you can use a portion of that to go into the more aggressive names. But you also need to look at the broader market, I think, because as Rich and I were talking about last week, you've got US stock markets at record highs, European stock markets at record highs. It has been a great run for 2 years. Now, over the course of time, it should continue to go higher, but there's a sense maybe in the shorter term that we might see a bit of volatility, mainly because things have been so good that a lot of the good news is priced in. And we're not saying that there's a massive correction coming, but it just feels like people are too optimistic, because the stock markets are made up of fear and greed, really. That's what drives investors. At the moment, people are tending, I think, to get a bit greedy because you've seen months and months of gains. But yeah, I think you have to use some of your funds as almost the learning that you pay to understand the market, and know that, okay, if you put some money in some of these more aggressive stocks, they could do really, really well. And there are sort of rules of thumb for reducing your allocation as well when they've done well. So if you have a stock that, for example, doubled, you could then sell some of the shares that have doubled in value and still end up with the same allocation. You can put that money somewhere else. So you don't have to leave the portfolio entirely static, to sort of, not to go back on what we said about doing less, but you can sort of, it's like a garden. You have to prune it. You have to say, oh, this asset or this stock has done really well, so I'd like to maybe reduce the allocation.
So it's like rebalancing.
Yeah, rebalancing, and some of the managed portfolios will do that for you anyway. So they will sort of recognise that. The portfolio manager, for example, Martin and Aaron here, they do that through BlackRock as well. They will say, oh, US stocks have done very, very well, so now we're overweight. We didn't intend to be overweight, but because they've done so well, their segment of the portfolio is suddenly very big. So we'll reduce that because there's a lot of dependence on that one sector, and we'll put it somewhere else. So you do have to regularly review these things. It could be that you do your dollar cost averaging every month and you don't really look at it, but it doesn't hurt just to sort of give it a spring clean, a tidy up, whatever you want to call it, every so often, and to see what's doing well and also what's not doing well, because that has to come, that awkward decision sometimes to say, I need to cut that stock because it's not doing well.
Yeah.
Or the reason I bought it, it's no longer there. I think I should put my money elsewhere, because if you're not using that money wisely, it's just being wasted, really.
That makes so much sense. Thank you for that. And I think my last question is, over the course of your career, like, what sorts of mistakes have you seen beginner investors make? And how would you advise that I don't make the same mistakes?
Yeah, the classic one is just to put all your money into one area, into one stock. And it can pay off tremendously well, but it's that risk that something goes wrong. And one of Buffett's favourite rules is don't lose money. Now, everyone loses money in the stock market. Nobody's perfect. But his point would be don't lose too much money. And you do that by reducing the risk that one particular part of your portfolio will wipe out all the others.
Yeah.
So it's sort of, if you back the wrong horse, it's not such a bad thing if you've got several others. Sort of extend the metaphor. That's always the key mistake. And people get over optimistic. They don't take enough time before they jump into an investment. They don't read. You don't have to read the company reports in detail, but you have a rough idea of what it does.
Like, know where your money is going.
Yeah. No, why would I buy this stock? Because you should almost look at it saying, I'm buying a stake in the company.
Exactly.
Why should I buy this company? What is it doing? Does it make money, essentially? And look, even professional investors don't ask these questions. There are plenty of people who've thrown money at stuff and then see it disappear because they haven't looked at the numbers. They haven't understood why they should be investing in something. So it's that lack of care. Again, Jesse Livermore said that a lot of people would devote less time to stock purchases than they would thinking about buying a car.
Yeah.
They'll spend ages picking a car, but they'll look at stocks and go, oh, I'll just have that, and they don't care why.
That's so true.
So I think it's really important that you do have to put your homework in. It can't be a thing that you just, if you have that interest, as you've started doing, you can't just sort of throw it into something and hope and just check it a few years later and discover it.
And hope that it's grown.
Yeah, hope is not a strategy as well. People go, oh, I hope my stock will come back. I've watched it go down in price. The other classic mistake is they, as we said earlier, they average down. So this is different from the dollar cost averaging, but if you say bought something and then it dropped 10%, oh, well, it's cheaper now, so I'll buy some more, and the hope that it will then go up again. Whereas I think what you should be doing is looking for stocks that have a combination of good fundamentals, so things like good, it's fairly valued, it's got a dividend, it's not too expensive, but also if the share price is rising, because it sounds silly, but if something's already rising over the longer term, that's the market giving it a vote of confidence.
Yeah.
It's saying we think the prospects are good and people are clearly willing to pay more for the stocks. Yeah. So you heard the whole thing about buy low, sell high. A lot of people say actually the way to look at it is sort of buy high but sell higher, because you are looking for the combination of the good fundamentals, the good valuation, but also the market, if you like, giving it the thumbs up to say, yes, we think this something the company's doing, or this asset, we can expand this to countries or sectors or stocks, and you can look at it on the same basis, really, rather than picking something that's going down. I think is the key thing. There's always that, I want to buy a cheap company because it might turn around. People always like those stories of, I bought a company.
So cheap.
Yeah, they were cheap down here. Yeah, but sometimes, as I say, things are cheap for a reason. Look at things like Burberry. It's had a great run the last couple of months, but it's been declining for a while because people think the outlook doesn't look very positive. It's simply down to that. And it's the kind of thing you need to do in looking at your investments, to regularly review them and ask yourself, is the reason why I bought this particular asset still there?
Yeah.
Should I still be in it? Is there a better place for my money to be put to work? So those the kind of thing beginners make. I think people get over optimistic, and obviously these are the kind of things that happen even more so in trading. Really, they sort of throw too much money in all at once in one position, and they're not very good at managing their risk. But that's the key thing, really. If you can understand risk a bit better, and I think learning that things go up and down is the key thing, really, then you're a lot further ahead than a lot of people when they're starting out in investing.
That is so interesting. Thank you so much for that.
It's a pleasure. I think, what we'd like to see IG is a lot more people taking that active interest, really. And I think it's a lot easier now than it used to be, because you've got the advent of ETFs and managed portfolios and their various guys and the various providers, but you can get exposure to a broad market in the way that you just couldn't have done years ago. And also the other thing is, the other key thing you have to understand is the expenses that you're paying to invest. So that's why there's this big focus when ETFs they're so cheap, and you can get exposure to the whole FTSE 100 by paying a tiny amount of expense. Because that's the problem with fund managers, is obviously you have to pay them to manage the money, so they take a percentage of fees. And when I worked in fund management very briefly, it was that, our performance was this, and we made 5%, but net of fees, our performance was 1%. So we made money, but you underperformed the index, and you still charged people
so much money
for the privilege of doing so. So I think it's so much easier now for the investor when they're starting out than it would have been
back in the day.
Yeah, well, even 10 years ago. I mean, not even back in the day, thanks for making me sound old there. But not that long ago. And ETFs, I really think they're a good thing, and it's a shame in some ways that it just hasn't taken off here in the same way that it has in the US. But they're a really good way of getting exposure. I think they've also gone too far. I think in the way that finance does, it takes a really good idea and takes it too far, because now you can get ETFs in almost everything, in every sector. There are thousands.
Lots of ETFs.
I think, is it true there are more ETFs now than stocks?
I think so.
It's getting that way, really. But if you use the sensible ones to track an index, to track a country, you can almost say, I think emerging markets will do well, or I'll buy a little bit of that, and then you can start with the US. So you can really spread your risk around in a way that just wasn't possible in the dim and distant past of about 10 years ago.
So basically ETFs are a good way to diversify at a very low cost as well.
Yes, and that's the key thing, that a lot of investors' performance is so hurt by the costs. Okay, they do okay in terms of performance returns, but once you factor in the costs, they really get knocked back. There's the stat that the S&P is up something like 24% so far this year, but the average retail investor globally is up something like 5%.
Ooh.
And this was a year where you could just bought it on the 1st of January and you didn't look at it for the next 12 months. Now, not every year is like that, but it is the case. And it's a lot harder, unfortunately, than it seems, really. And partly it's because, as you realised, a lot of people get the urge to do something and fiddle about with their investments too much. And that, of course, the more you trade, the more you place investments, that's a cost as well. So that's another reason you have to be careful about making the initial decision, and also then making changes as you go.
Thank you so much, Chris.
That's a pleasure. That was really good. It's really sort of good conversation to have, and I hope that some other people take some lessons from that particularly. We just have one segment for the end of the week, or the end of the podcast rather. We can cut that bit out, which is our On This Day. So we just look at events that happen on this day.
Okay.
So it's the 9th of December, so we are barreling terribly close towards Christmas. Are you ready for Christmas?
Yes, I'm excited.
Really? You all ready? You're all wrapped and presents bought?
Presents bought, dresses bought, tree bought, everything ready.
And they're all wrapped and done?
Yes.
Oh my goodness, I've not even sent my cards yet. It's ridiculous. I think we've got most of our presents, but still not all of them. Right, that's scary. You should come on the podcast more often. You're much more prepared. On this day, for once, it's not that busy a day, the 9th of December. All I've got so far, and I have to keep an ancient history reference in, the Byzantine general Belisarius entered Rome on this day in 536. And then also this day, 1905, in France, was the famous law passed that separates church and state. So that's mostly... There's no business... I don't think any business events on this day. So slightly thinner pickings this week for On This Day. But Queen, thank you so much for joining us. We really enjoyed having you.
Thank you for having me.
We hope to have you again to hear more of your investing war stories, because they're always great. Aaron should be back next week from South America, and he can update us all on the beef he's no doubt sampled on the way. But I've been Chris Beauchamp. Thank you very much for joining us, and we'll see you again next week.